The U.S. labor market is showing unexpected strength, and that strength has just sent a shockwave through the financial system. The May non-farm payrolls report revealed that the economy added 172,000 jobs, nearly doubling the market's consensus expectation of 88,000. While a strong job market sounds positive, it has completely shattered the disinflation narrative that supported the market's 9-week winning streak. Investors are suddenly realizing that the labor market is running hot, and the era of easy rate cuts is off the table. The reaction in the interest rate markets was immediate and violent. Instead of looking forward to monetary easing, traders are now repricing the risk of another interest rate hike. Quantitative tools show that the probability of a 25 basis point Fed rate hike by December has surged to over 42%, with some option markets pricing in actions as early as October. In response, Treasury yields spiked across the curve as bond prices plummeted, forcing equity valuations to adjust to a higher-for-longer rate environment. As yields surged, the stock market's upward momentum hit a wall. Major equity indices, including the S&P 500 and the NASDAQ, broke below their crucial 20-day moving averages and key long-term trend lines. Technical analysts note that this breakdown signals a structural shift in the market's trend, transitioning from a persistent uptrend into a short-term rollover and a defensive corrective phase. The sell-off was concentrated in the market's most crowded leaders. The semiconductor sector, which had powered the year-to-date rally with gains of over 60%, experienced a sharp 5% drop this week. This momentum loss pushed the semiconductor index violently below its own 20-day moving average, confirming that the leading group of the bull market is undergoing a significant and broad valuation pullback. Broadcom became the epicenter of this semiconductor pullback. Despite reporting strong second-quarter earnings, the company's third-quarter AI chip revenue guidance of $16 billion fell short of aggressive investor whisper numbers of over $17 billion. This expectations gap triggered a massive 2-day, 22% drop in Broadcom's stock as short-selling volume surged, illustrating how even strong growth can lead to sharp capitulation when stock prices are priced for perfection. Adding to the equity pressure is a sudden shift in tech sector financing. Rather than supporting stock prices through share buybacks, mega-cap tech giants are now seeking massive capital from the public markets to fund their AI infrastructure build-out. Alphabet announced a massive $80 billion secondary offering, which was upsized to nearly $85 billion to support its capital expenditures. Meanwhile, reports emerged that Meta Platforms is considering its own multi-billion-dollar equity sale, draining liquidity from the stock market. This public market cash drain is coinciding with a massive liquidity squeeze in the private markets. SpaceX has filed for a record-setting $75 billion initial public offering, priced at $135 per share. Institutional investors are actively liquidating their high-flying public tech holdings to raise cash to participate in this historic private-to-public debut, creating a temporary liquidity vacuum across the major indices. The SpaceX listing faced additional pressure after index providers intervened. S&P Dow Jones Indices rejected a proposal that would have allowed massive companies like SpaceX to be fast-tracked into indices immediately upon listing. This decision means passive index funds will not be forced to buy SpaceX shares immediately, reducing the expected passive flow support and adding to the short-term valuation uncertainty for the upcoming debut. These compounding pressures have led value investors to warn of structural bubble risks. With the S&P 500's dividend yield dropping to a mere 1% and the Shiller PE ratio climbing to 42, the market is trading at one of the highest valuations in human history. Historically, valuation levels this extreme, seen only in 1929 and 1999, have preceded major real-term market corrections or periods of persistent inflationary pressure. As market volatility rises, retail investors are falling victim to complex high-yield traps. Funds investing in below-investment-grade collateralized loan obligations advertise yields above 20%. Yet historical data shows these vehicles have destroyed up to 82% of investor capital over the last decade. Similarly, single-stock covered call ETFs like TSLA have delivered negligible returns when accounting for net asset value erosion, demonstrating the risk of chasing yield in a declining market. To sustain their high valuations, tech giants must prove they can monetize their AI investments. Meta has introduced Meta Business Agent, a paid subscription customer service tool that helps businesses automate interactions. This represents a strategic transition from an advertising-only business model toward a predictable, recurring software-as-a-service model, which analysts suggest could help support Meta's multiple if successfully adopted.
Market rotation is shifting focus away from hardware suppliers toward companies that can distribute AI services to massive user bases. Apple's upcoming Worldwide Developer Conference is expected to serve as a major catalyst for its AI software integrations. At the same time, Alphabet is positioned as a uniquely cheap alternative, trading at 27 times forward earnings while possessing a complete stack from custom chips and cloud computing to consumer models. In a high-interest rate environment where the market's margin for error is thin, capital preservation is paramount. The key is to avoid yield traps and maintain a high cash position, focusing only on companies with robust balance sheets and resilient cash flows. By emphasizing value and selectivity, investors can protect their wealth and position themselves for high-quality opportunities as valuations adjust.